Most people who enter the markets are drawn by a powerful allure. They see the potential for great wealth and financial freedom. They hear stories of traders who turned a small stake into a fortune. This dream is what fuels the industry. Bustling floors of Chicago, quiet screens of home offices, yet there is a harsh reality that is often whispered but rarely shouted. The vast majority of aspiring traders fail. They don't just fail to get rich, they lose their entire starting capital. They wash out of the markets within their first year. The reasons boil down to a fundamental misunderstanding of what trading truly is. Newcomers believe success lies in finding a magical indicator or secret formula. They chase hot tips and follow so-called gurus. That quest for a perfect entry signal blinds them to the single most important element of long-term survival. It is not about being right all the time, it is about managing what happens when you are wrong. For decades, I have searched for the common thread that ties all great traders together. I have interviewed dozens of the world's best futures traders and hedge fund managers. I found that they employed wildly different strategies. Some were fundamental analysts, others pure technicians, some held positions for months, others for mere minutes. Yet beneath these surface differences, one unifying principle was always present: an obsessive focus on managing risk. This, I came to realize, is the true holy grail that so many seek in vain. It is not a secret indicator but a disciplined mindset. Risk management is, at its core, a defensive strategy. It is the practice of defining your potential loss on any single trade before you even enter it. Think of it as a prenuptial agreement with the market. You decide, with a clear and rational mind, the maximum amount of your capital you are willing to risk for the chance of a profit. It prioritizes the preservation of your trading capital above all else. Without capital, you are out of the game. Let us imagine two traders, both starting with $50,000. Gary the gambler and Mary the manager. Both are looking at the same stock, believing it is poised for a significant move upward. Gary, driven by excitement, decides to go all in. He invests his entire $50,000 with no plan for what to do if the trade goes against him. His strategy is hope. He dreams of the stock doubling, turning his stake into $100,000. This is the mindset of the amateur, the gambler who is betting the farm on a single roll of the dice. Mary approaches the same opportunity with a completely different mindset. She believes the stock will go up, but is acutely aware she could be wrong. She decides to risk no more than 1% of her account capital on this single idea. That amounts to $500. She places a stop-loss order, ensuring her loss will be capped at $500. Her potential for profit is large, but her potential loss is controlled. An unexpected negative news event hits overnight, and the stock opens 20% lower the next day. Gary wakes to a nightmare. His position is now worth $40,000, a devastating $10,000 loss. Mary's stop-loss was triggered automatically. She lost $500 exactly as planned. Her account stands at $49,500. While Gary is paralyzed by his huge loss, Mary is already scanning for the next opportunity, her capital almost fully intact. I once knew a young, brilliant trader. He had developed a fantastic system for trading stock index futures. For months he was on fire. He pyramided his profits with remarkable skill, quickly turning a modest stake into a small fortune. His confidence grew to hubris. He felt invincible, believing his system was infallible. He thought risk management was for lesser traders. His downfall came during unusual market volatility. A sudden reversal caught him wrong side with a massive position. This time was different. The market didn't bounce back, it kept falling day after day. His paper profits evaporated, then his original capital began to erode. Instead of cutting losses, he added to his position, convinced this was a buying opportunity. Margin calls began coming in from his broker. Within a week, his entire account was completely wiped out. He had allowed one bad trade to take him out of the game permanently. The math of losing money is brutally unforgiving. A 50% loss requires a 100% gain just to break even. A large loss puts you in a deep hole that's incredibly difficult to climb out of. Successful traders focus on positive asymmetry, risking $1 to make $3, $5, or $10. With asymmetric bets, you can be wrong most of the time and still be profitable. You do not need complex algorithms or expensive software. The most powerful tools are simple concepts any beginner can implement from day one. The most fundamental is the stop-loss order, a preset order that automatically sells when price reaches a set level. It is your ultimate safety net. Position sizing determines capital allocation per trade, directly linked to your stop-loss. This keeps risk consistent regardless of stock price or volatility. The rule of 1%. Never risk more than 1% of total trading capital on any single trade. For a $50,000 account, that's $500 maximum. This rule keeps you in the game. You could have 30 consecutive losing trades and still have significant starting capital intact. Keep a detailed trading journal tracking decisions, not just profits and losses. It reveals weaknesses and lets you analyze performance objectively. There's an old Wall Street saying attributed to Warren Buffett. Rule number 1, never lose money. Rule number 2, never forget rule number 1. Your trading capital is your inventory, raw material, tool of the trade. Without it, you are no longer a trader, you are just an observer. Think like a business owner. They would never risk their entire company on a single venture. They manage finances carefully and ensure survival during slow periods. In the search for a trading edge, most people look in the wrong place. They believe an edge is a secret pattern, complex algorithm, or insider information. The reality is that the true, sustainable edge does not come from predicting winners. It comes from the masterful management of risk. You have no control over trade outcomes once entered. However, you have absolute control over how much you are willing to lose if wrong. Many successful traders I've interviewed have surprising win rates, often 40 to 50%. They are wrong as often as they are right. Their edge is not being right more often, but that their average winning trade is many times larger than their average losing trade. This is a profound shift in perspective. You can stop searching for a perfect system and stop berating yourself for losses. Losing is normal and unavoidable. We have explored why most traders fail and illuminated the path of the successful few. The difference is not genius or secret formulas, it is unwavering commitment to risk management. Trading is a marathon, not a sprint. Risk management is the pacing that gets you to the finish line. The tools are simple. Use stop losses, calculate position size, keep detailed journals, focus on asymmetric opportunities. These are fundamentals for every market participant. Your mission starts today. Stop asking, how much can I make? Start asking, how much can I lose and can I live with that? Make capital preservation your priority. Become a master of risk control, not market prediction. This is your lasting edge. Take control of your destiny by taking control of your risk. Read about it, study it, practice it with unyielding discipline on every trade. Master risk management, and you'll survive and have the potential to thrive.